very warm welcome to everyone. I am Shuja Agrawal, and you're watching the Mint Startup Diaries. Before we get into this, it's time to do some context setting for the same exactly what we're going to talk here. The seed fund market today is highly fragmented, and it's been bulking up with investors who are usually known for writing bigger checks. Look at funds like Index Ventures Sequoia Capital, would unveil seed funds of about $200 million. Even other multi-stage firms like Greylock Partners, Anderson Horowitz, which usually makes investment at Series A or B round, have announced seed-focused pools of capital with hundreds of millions, have embraced the seed market where historically VCs have been less competitive. As rounds get more and more competitive, especially beyond Series A, VCs seem to be trying to secure stakes that are comparatively cheaper in startups that seem promising as early as possible, even in the larval stages, and then grow their prominence in subsequent rounds over time. With the sort of the venture capital model, the VC model already being appended with a degree of unprecedented hyperactivity and an overabundance of capital, it seems justified that VCs would try to get a head start when they find startups with the potential to succeed and sustain, especially when the later stage rounds command much higher valuation. And so, with the VC system abuzz with activity, the seed market seems to be creating a niche of its own in the entire framework. But is this entirely prudent for VCs who would benefit from the step in valuations later on? Or is there some sort of FOMO or fear of missing out with VCs worrying if they don't get in at the ground floor for startups that show any sign of traction, they would miss out on being part of something magical? How does this affect pricing and exit valuations? Are startups really getting too much money too early on? To break it all down, please help me welcome Sanjay Mehta, founder 100x, Rajesh Sehgal, angel investor, managing partner, Equanimity Investments, and Esha Tiwary, general manager, entrepreneur first. It's my sheer pleasure and privilege to sort of welcome all three of you on this very meaningful discussion I mean to have the next 30 minutes with all of you. My first question really is that what we are seeing in the VC industry is not a secret anymore. We began with like one unicorn last year to where we are right now. The numbers just seem to be increasing. There seems to be this benign liquidity environment, which everybody seems to be taking advantage of, from the VCs to the startups. There are noises coming to the fore. It's the best time to be an entrepreneur. The roaring 90s are back. VCs never had it so good. We seem to have become this unicorn churning machine. Everybody, even leaving the peak of their careers, I'm very, very sort of enticed to be an entrepreneur. Now, my question is that when you see this kind of hyper funding activity in the VC industry, where the VC market itself is being appended with the likes of SoftBank and Tiger Global, what does it really mean for the seed funds? How are they trying to establish a niche for themselves? I'll begin with you, Sanjay, get on to Rajesh, and then Esha.
Sure. What would you like me to comment on, Srija?
I would like to understand, what does it really mean to be a seed stage fund or a seed stage fund manager at a time when capital is no more remote, when capital is so freely available?
I think these are great times for seed stage investors. Uh, I assume more liquidity into the market, more startups get funded across. Uh, the story of entrepreneurs raising money straight from a big VCs, be it across Sequoia or Excel, starting with their Atom kind of stuff. It may sound glamorous, but it's not really productive, because most of this big funds who have started the seed stage are actually buying call put options, right? 'Cause saying that, if the deal goes great, they would write the further check. But the signaling is bad for the entrepreneurs, because if these funds don't write the follow-on check, nobody else in the VC ecosystem will write the check, because the signaling is very clear that these deals are not performing. So, and entrepreneurs fall for it because it's a glamorous name. Okay, we got funded by XYZ kind of stuff. But in a real sense, if you look into the startups' success out of the whole numbers which has been churned across on this seed funding by so-called big VCs, the success has not been great because the partner level people are going to spend time on their successful portfolio. They are not going to spend time on this small investments of 250k 500k, and the outcomes are very different. Typically it's being managed so called by newbie into the VC ecosystem. It's very different. Whereas if you look into startups which go through the real rigor of going through an angel network, taking some money through angels who are operators who help them shape the company, who are putting their own money, it's a different journey what they carve out for themselves. And their chances of success are there because they can, even if they are little lagging behind, and they have got multiple chances to pitch to a VCs before they go out and raise a larger round. So idea is, the way I see across is, while it may sound very glamorous in terms of raising money from VC, the fact that the valuation and amount of capital startup raised in their first round from venture capital firm is typically inversely correlated with the startup success. That's what I would like to mention.
Okay, Rajesh, I come to you. A pretty strong statement coming out from Sanjay here, given that 3 points that he clearly mentioned. One is the entire bandwidth equation in large VC firms, where he said that perhaps the attention, and rightly so, could be in churning out the next unicorn rather than giving that time, attention, and energy and space to a small B investment. Second, he also spoke about the fact that the entire investment structure is very, very fund centric and not entrepreneur first, where it's very call put option oriented, and you sort of become very, very opportunistic in that sense. And third, this entire thing that he sort of spoke about the fact that the startup needs to go through the grind of going through angel networks and startup funds than perhaps being in a better position to raise a larger corpus from a VC firm. I would like to understand what really would your reaction really be? Seed funds trying to establish a niche for themselves in a hyper funded and hyper liquidity VC environment.
I think Sanjay has hit the nail on the head. I totally agree with the points that he's made. And just to add to that, I think the way to look at it is, we should never forget that India is still a poor country, right? As much as when I pick up the papers in the morning and I see $50 million here, $100 million there, and all that, one more unicorn that's come out. But I think the reality on the ground is very different. We are a capital-starved country even now. There's enough and more absorption capacity in the Indian economy to take in money from a variety of new sources that have recently started looking at India as a destination to park their money. And this is not just in the VC ecosystem, by the way, or early stage startups. I think you pick up any sector in India, whether it is healthcare, whether it is consumer, is fintech, or education technology, pick up any sector. And I think each of these sectors can absorb tens and hundreds of billions of dollars. And each of these sectors can by themselves have 5, 10, 20 unicorns, because we are such a large economy, right? But that said, I think when larger funds get into seed stage investments, the question to ask is why? Why would a Sequoia or an Axel or any of the larger names that you mentioned earlier, Shrija, why would they want to do these small ticket investments? To my mind, one of the reasons can be is that they are preparing their own deal pipeline. Why are they preparing their own deal pipeline? Because the opportunity set on the ground is so large, and the number of seed funds, even though they've grown by such a number, are still unable to back entrepreneurs who really want to start up something. So it's just a sign from these guys that the opportunity size is huge, and we will wait till we have many more such seed funds like Equanimity, like us, like what Sanjay Bhai is doing, like what all of us are doing. And so therefore the opportunity, it's a simple signal that the opportunity is too large to wait around for the ecosystem to grow and mature by themselves. Let's put our money on the table and give confidence to entrepreneurs on the ground. I would read it that way.
Okay, thanks for
I
that.
would like to add a comment here, Srija, if you allow.
Sure.
you know, adding to what Rajesh mentioned across, when there is large sums of capital invested or a big VC invest with the like a first check, into the company, it creates actually a pressure cooker type of situation for entrepreneurs, right? It forces them to throw money to problems, and typically this VC capital always comes with non-negotiable deadlines to deliver. In comparison to the seed funds or the angel investor rounds are more measured. It forces them to make optimum use of capital and a focused approach on experimentation, more flexibility to adopt learning. It's not like a stone deadline. So my take is, while it may sound, as I am repeating, but it may sound glamorous to pick up that first check from a big VC name, but it's detrimental for future.
Okay. Sanjay clearly is rooting for his capital and not take the capital from a VC firm. The messaging is loud to startup out there that can actually be detrimental to you. You might find it very branded by this Axel funded or Sequoia funded, but perhaps it's more prudent to raise money first check from a seed fund. And Rajesh's voice was pretty much about the opportunity set that's given India as a vast, expansive country and given a third world country that we are poor, capital starved, and a lot of unicorns can come from infrastructure heavy sectors like healthcare, telecom, education, and so on. Isha, I wonder what is really your view. You heard both your male counterparts making those points, perhaps the strides against the VC firm. What really is your view here? Yeah.
It's very interesting to hear both Sanjay and Rajesh. I actually have a very different point of view. I'm quite excited about all the frenzy and very much welcome it. I think just building a little bit on what Rajesh was saying, it is all about, if you think about why this frenzy is happening, right? So there's a huge influx of capital in the later stage. So lots of international money, lots of new funds, all of that pouring into later stage. What that means is the larger VCs are seeing a lot of competition in their later stage deals. So what they're trying to do is then get earlier and earlier to secure the deal flow, and make sure that they have access to the best deals as the startups are maturing. Hence, them venturing into early stage deals before they were never looking at that. And with the larger funds coming into earlier stage deals, seed funds are seeing that intense competition, right? And that's what we're talking about today. I think that's great. If you think about the entrepreneur's perspective, that kind of competition in early stage is great. This means funds are investing earlier than they ever were before. This means prices are good. This means everyone's vying for the best deals. And I think this is a better situation if you think about entrepreneurs from what it used to be earlier. When we had launched Entrepreneur First in India about 3 years ago, as our startups were getting ready for their first institutional seed rounds, it was difficult. There were very few investors. Even though they were seed investors, very few people actually investing in early stage. Everyone was looking for like huge amounts of validation, lots of traction, etc., which is a very different situation to other geographies like Europe and US, where seed deals are happening at much earlier stages. Conviction is built much earlier. So from an entrepreneur's perspective, the fact that there were very few seed investors earlier really doing early stage deals, it was much harder and much more difficult to actually get the right backers. Today, given the amount of competition and the amount of capital available, I think it's a great time for entrepreneurs because you have people showing conviction much earlier. You have access to a wide range of capital, and you have the choice around whether you want to go with a larger fund or a seed fund, whether you need your investor to be super hands-on and an operator, like Sanjay said, or you actually need them to be, a larger player who can give you access to later stage funding opportunities. So I
Okay.
think that's one very important aspect of why I think this is a good thing. I think there's another an aspect that I'll touch on, Shrija, which is I really like the term Sanjay used, which is this pressure cooker term. Again, I think that's a great thing. In fact, some of our my experience has been entrepreneurs do their best work when they feel like they're in a pressure cooker. Like when you have an intense environment, a lot of the negative stuff gets preponed. You're forced to think creatively, come up with solutions. You're not thinking incremental, you're thinking step changes. So even there, I feel it's a great thing that we have so much frenzy in seed stage
So
right now.
here, I'd like to have a contradiction. So let's put in, you have 34 portfolio companies, all get funded by a big VC. Out of that, they are only going to select 4 or 5 to go across the next round. That's it. The rest of the guys fall apart. Because
No, so,
if the big
yeah.
VC doesn't invest, there is nobody who's going to fund those companies, because the signaling is very clear that this is not happening. The idea here is the founders have to go through the right churn, go and, skipping the line doesn't help the
No,
founders.
that's
If
not.
you keep
I don't think
talking,
that's skipping the line, Sanjay. You're right. I think there is a massive signaling thing that has to be spoken about. But I think that's the reality. Because if you think of if you think of seed fund for your own portfolio, right? Like there's always going to be certain companies where you're going to whether lead or follow on next rounds to a
we
very
don't do
different
follow
level.
on. As a seed
Okay, so
investor,
I think
we don't do
so. I
follow on.
think it is not about an 100x versus
No, it's not
Esha.
100x. The idea is, Srija, the whole
Uh,
perspective here is, uh, raising money first check from a big VC, right? While today all VCs are coming at seed stage. Is this right for the ecosystem or not?
but that's the
Right? Is
question we
this
began the
going to
premise
value?
with, and it's interesting. All of you have a different point of view. I think Isha's point comes from the fact that how the ecosystem is maturing, just the way we have seen the private equity as an asset class maturing, and a lot different kinds of capital pools coming at different stages: Series A, Series B, Series C, a very growth oriented model. Perhaps we are seeing the similar kind of capital. We are seeing it a more risk oriented framework in the VC model. That being said, I also agree, and also tend to agree with the fact that if you look at the CB Insight study, it says that for startups, raising too much capital too soon, perhaps from a branded VC, can actually be detrimental. A lot of startups have failed because they raised too much capital too early on. And in fact, they have named this entire phenomenon as capital foie gras. And this is essentially what is really playing out in the VC world, where VCs have so much capital to throw that they're literally choking the founders with so much capital. And really, the entire premise in the question here was that how are seed funds like yours really trying to establish a differentiation? Interesting viewpoints from all three of you, I must say this. Now, let's break this down into three subparts. First thing is, Isha spoke about the frenzy. Now, how is that frenzy translated into deal making? Let's get you on, Sanjay, first. Has deal making simplified? Has deal making become more competitive? Have founders have very inflated egos that suppose if you don't give me a check, I'll get on to the other one because capital is available? Because deals are happening at such breaking neck speed right now. VCs have never been so busy. So how do you run a shop where capital is just literally throwing around and everybody's throwing capital at each other?
Sure. So, Shija, personally, in last 10 years, maybe now 11th year, invested over, 150 odd startups, 4 unicorns in the portfolio. I could see visible opportunities within the Indian venture ecosystem. And that's why in 2019, we started 100x VC. First was, we solved the problems by simplifying first check funding, which means becoming the lead investor by using iSafe note, which is a simple convertible note. Over the counter, you can do an investment. You don't need a draconian kind of shareholder agreement when you are at seed stage. Second problem we solved was for investors on discovering, fundable or endorsed deal flow. In last 2 years, we would have seen at 100x more than 15,000 odd deals for funding. This proves that 100x model was well accepted with capital and education. So we get access to top tier deal flow while we invest the first check, and we do that in a cohort based model, and that differentiates because we build a community around the whole startup, and there's a lot of peer learning which goes over there. And now we have earned a reputation of selecting all fundable deals. And today, entrepreneurs seek 100x brand on their cap table because it becomes like a social proof, right? Once we are on the cap table. And this is happening because we get those proprietary winning deals. In fact, out of the 60 deals till now, what we have announced as a funding, 51 have raised the next round of funding. And I think that all, I would say, across is because of our experience and exposure of 100x. While we look at network, preparedness, activity, and reputation as four pillars, how we differentiate ourselves from plethora of other investors kind of there in the market kind of stuff. So while we work on each deal meticulously, but we now have we call that as a muscle memory or pattern matching in terms of experience of deal evaluation, that these are the deals that are likely to scale or be an outlier hit kind of stuff. So I think from a process perspective, we have simplified the whole investing using iSafe, and we were the pioneer in the same. And today we have outsourced, and everybody are able to use at seed stage to raise money
Okay.
without using the SHA.
Great. So there are two aspects to it. One, of course, is that you also had to travel some journey to reach to a stage where founders come to you and want you on their cap table, and everybody goes through their journey. And second, while you also owe your success to your process, but also you can't take away the fact that the VC market or the ecosystem has fairly matured, and there is capital available which can feed to subsequent rounds of funding, the point which also Esha was making. So Esha, my question to you really is that you spoke about the frenzy and what you're seeing. So how has that contributed to the deal making, perhaps in your portfolio? How has that truly helped or not helped you in your portfolio?
Yeah, absolutely. I think there's a slightly different perspective for us because EF sits before the seed deal portfolio, right? So we actually partner with early stage funds who invest in the startups that get formed on the EF platform, because on EF platform, people join as an individual and then they go on to build their startup. I think the change this year has been dramatic. So the speed of deals, to your point as well, Shrija, the speed at which seed deals are happening. So typically when we would do an investor day, so the startups that we fund would then, get access to the best VCs in the country, seed VCs, and then they would sort of start working towards their seed deals. Usually, that would be anywhere from 6 to 12 months where most of those deals would get closed. Today, I already have 50% of my most recent cohort committed seed within 2 months. And that's a dramatic shift, right? So, definitely agree with your observation. I think, and that's what I was also referring to, that a lot of this is good for investors, for entrepreneurs, because there's so much interest in early stage deals. I think I also agree with the earlier point being made, which was too much money is not good for founders. And I think that's a very valid point, right? But having a lot of people looking at early stage is slightly different, and we're definitely seeing that happening.
Okay. To your point, Rajesh, I think interesting points made by both Sanjay and Esha. Sanjay spoke about the fact that, how they pioneered some of the processes at their fund, and that kind of helped them establish the brand, and how Esha has said that the entire process leapfrogged from 34 to around 50 pre-seed stage commitment, she's saying, just given the kind of hyperactivity we see in the ecosystem, and that really is helping her build a deal pipeline. What about you? How has this entire frenzy, what has it meant for you the past 6-7 months, the COVID induced growth or hyper growth that we have seen?
Yeah. No, I think this. So let's step back to pre-COVID, right? What were we doing pre-COVID? I think as we, pre-COVID, we were all, investing in startups. Seed stage funding was happening. Some of the larger funds had already started deploying capital in early seed stage companies as well. So as much as we can attribute these big changes to COVID, I think what COVID did was accelerate the pace of this change. The change is unidirectional. I think it's here to stay. I think it's a reflection of what's happening in India compared to where we are, what's happening globally. The pandemic has only accelerated the whole thing. If you recall, not more than 12, 18 months back, every forecaster, every luminary who comments on global developments, etc., everybody was of the view that COVID-19, will leave disaster in its wake. High unemployment, widespread bankruptcies, households will not have money to spend, businesses will not do capex. I think look at where we are now. It's completely diametrically opposite. Households are spending money, capex is getting done on the ground, and you just have to travel in India or by road or by train to see what kind of infrastructure is getting built. It is getting built, whether you believe it or not. And where is the unemployment? I mean, I think there's for qualified people, I think salary levels have gone up. People are competing for talent. You may attribute this to capital being infused into early stage startup companies, and therefore technology guys are being sought after. But I can share with you that this talent crunch is not only in technology, careers, but across. So you talk to HR leaders, and they will attest to this, that there is a real demand for talent today. Why is there a demand for talent? Because there is so much business, so many businesses getting built out, so many larger businesses growing from where they were. So I think rather than calling this a kind of a mania or a frenzy, I think it's just very natural to understand that COVID has really accelerated the pace of changes. Business models have changed. Everybody has had to, whether we liked it or not, adopt digitization and technology. Older, people beyond 50, 60 who would earlier never pick up a digital phone for anything and say, "Humko samajh mein nahi aata hai." They are like prolifically consuming not only content, but also doing commerce online, right?
Yeah.
Businesses, larger businesses, forget about early stage, seed stage and all that. Larger businesses who are very reticent and about technology adoption, digitization. I think every consultant worth their name who's done anything in digitization is today busy. Right? So I think this is a change, and we must all embrace this change. In terms of capital flows, there is a lot more capital flowing into India. And as I said in my opening comment, there is larger capacity for capital to be absorbed in India. And I welcome not only the early stage companies who are investing into the seed stage in our ecosystem of seed to Series A, but I welcome all corporates. I want more larger corporates to have corporate venture capital funds within their on their balance sheets, within their ecosystems, because they will be able to not only bring capital but also other value add for startups and for early stage companies. And I can assure you one thing: the number of deals that we see at Equanimity year on year is only going up. It's not going down. It's not that we are not seeing good deals, right? We are still seeing good deals, many of them. Our strategy has always been to invest in 5 to 7 companies. So we're very picky, choosy about people we partner with. And I think that is, directly a result of how we are able to really work with them. Like Sanjay said in the beginning, we are able to devote time to our founders, work very closely with them, build the business with them. And, of course, there are ups and downs, and there are times when, we are all on cloud nine. The next day we are all down in the dumps. You have to go with that, with the founders and the founding team on that journey. Really understand and build that business. So I don't think there's been any crunch for deals or finding good founders. My view is, Shira, honestly, this is just the beginning. The next 5 to 10 years, this is not building. This is
that's
going to
the
get
reason I
better and better.
always say that Rajesh is a balanced one, right? वो हमेशा एकदम से सबको समझा देता है. He's a balanced guy.
Yeah, I think all of you are fairly balanced. So we spoke about quite a few things, the opening remarks on the VC versus the seed stage fund. We spoke about the frenzy in the deal, make what it's really meant for you all. And now let's just talk about the fact that I take your point, Rajesh, that we are capital starved and we perhaps need this kind of capital. But what explains the valuation? I mean, I really can't figure out, VCs have to start using the bubble word. I mean, they don't use the B word yet. But the question and the reality is that we are in a bubble, clearly. And then there's no point being in denial about it anymore. So whilst you can argue with me that Shrija, as a nation, we need this much capital, but the valuations definitely cannot really be justified. And please don't give me the answer that the valuation lies in the eyes of the beholder. and we're not really buying that. Because I've seen and heard this from so many fund managers. The question really is that we are in a liquidity environment which is so benign, and one has to put the capital to work. And then you have the likes of SoftBank and Tiger Global, which have just raised so much mega funds. So this really has meant that the VC funds have had to append their capital structure. Sequoia is going for a structure where it says that we all just saw right now, with very long-term LP base. And all these are happening in the context of what we are seeing with the large multi-billion-dollar funds. So all this have repercussions across the value chain: VC, Series B, Series A, and seed. So let's spend the next 5 minutes to talk a little about valuations. So let me begin with you, Sanjay. What are your thoughts on valuations?
I mean, the way I see across is, as Rajesh said across, this is just a beginning. I don't see a bubble. High velocity startups will need to burn capital to sustain their growth and prior to achieving profitability. I don't see losing money is no one's priority. But we know the fact that startups which are focused on that rapid growth do lose money, right? And few startups tend to lose money over a longer time horizon than others for multiple reasons. And each startup, if you look into those unicorns or unicorns, has its own journey of making money, and there's no standard template to apply. VC firms back a lot of ideas with capital that will lose money in initial years and then discover the path to make tons of money. And I don't see, that startup losses which are being glorified in media, or, be critical about the valuations. Today, building a company which is on a rapid, kind of growth will need across this kind of capital, and they will do mistakes. We have seen across the public listed tech unicorns in US with losses have been faring better than their profitable counterparts. In fact, Rajesh can comment more on that. But I would say across, going for profitability too early, means limiting growth kind of stuff. And to get that capital, I mean, startup valuations are not dependent on those profit or loss, but on future growth prospects, right? And startup with accelerated goals build their businesses with use of VC funding, right? So I would clearly say that, this is not something where there is a bubble. I would say this is the beginning or the starting point. We are yet
Can
to
I
see
suggest one
the.
thing? I mean, yeah, I get your viewpoint, Sanjay. But just can I say one thing, that is somebody who has tracked this space for like about a decade or more than that, that VCs seem to be changing their goalposts too soon and too often. I must put this on record here. There were days when VCs used to really appreciate frugality. Now the days of frugality are over. Frugality is not a virtue appreciated by VCs anymore. Now they are actually
Hey,
rationalizing
I
this
disagree with
large.
that. Sorry, I completely disagree with that. I don't know
VCs
where you're
are
getting this from.
rationalizing. VCs are
No.
rationalizing the large fundraisers by saying you'd require the large fundraise for larger outcomes. But to say that this is not a bubble, but it's a new normal. So you belong to the. So basically, there are two separate sects here. One which say it's a frenzy mania bubble. The other which say that it is a new normal because you have such large outcomes. You need such large fundraisers. Sanjay, clearly you're on the second side. But I must say this, that VCs
Srija,
change
other
the
than you,
narrative
we are
too
not hearing
often.
anybody say there's a bubble. You're the only one who's saying bubble. Nobody else is saying that.
But VCs will not say it is self-serving to them. Why would you say it's a bubble self-serving to you? You're in that industry.
See, I'll tell you. Okay, allow me a couple of minutes. I'll talk about valuations, right? And just to give you a backdrop to this, I worked at Templeton for 20 years, and we are value investors at Templeton. So
Sure, yeah.
completely entrenched in fundamentals and valuation and P ratios and ROEs and all of that. So when I started investing in this ecosystem, and it's been about nearly 13, 14 years that I did my first angel investing, and 4 years since we started the fund. Valuation was always, it's when you do something for 20 years, it's kind of hard-coded inside you. So we are very, very valuation focused as well. But I'll tell you what, I've had a change of mind on this, and allow me to share that. So if you look at this whole valuation theory itself, the whole financial theory, Harry Markowitz started in 1950, portfolio management theory, etc. So all the progress that we've made in terms of understanding valuations of businesses is about 70 years old, not more than that, right? 70, 80 years old, max. All the theory that was developed was under a regime and time when businesses were only manufacturing. There was no other kind of business. It was the Industrial Revolution. They were all manufacturing companies. All financial investors were backing manufacturing processes and companies. Of course, there was a lot of innovation there itself, but it was all manufacturing. I think it is very, very sanguine for us to understand and very important for us to realize that the fabric of business itself has changed. And the technological improvement that we've seen since the 80s, 90s, and 2000s has completely changed business models. You can, like, for example, a very simple example, right? You look at FMCG companies. 20 years back, even 15 years back, even 10 years back, the biggest entry barrier to having a brand was reach, distribution. Today, that entry barrier is gone. So can I apply the same valuation metrics to the new age businesses who is saying I can now address not only India, but the whole world sitting in Jaipur or sitting in Cochin? You don't have to have a national footprint or a global footprint to start an FMCG or a branded business today at all. And this has been enabled by businesses like Amazon, Google, the likes, the social media, etc. So not going into specifics, I think the way we have to really understand the business landscape that has changed, and therefore there are companies, there will be business models which we haven't even seen yet, which maybe they haven't even been born yet. Entrepreneurs will come along, set up businesses that will really be showing you a new path of achieving supernormal growth. There was a time in India, or let's say globally, there were companies which would grow at 10-20% and there would be like super growth, correct? Now, forget about early stage companies. You have larger companies which have global operations, which are growing at that pace year on year for decades together, right? So if you tell me that the way to value these businesses is still the same that I used to value Tata Steel or ITC, then I'm sorry, no, those metrics have changed. And the sooner we realize that, the better. Is there a pickup in the pace of deal making, in the pace of deployment of capital? Of course, there is. But I think I still feel, and I'm very optimistic about that. I think it is very rooted in reality on the ground. You have to see. So in our portfolio, we have companies that have grown, and it's a real case, by the way. This company has grown 10 times in the last 12 months, right? In the next 6 months, we are going to grow another 10 times in revenues and without burning too much capital. So these are real world changes that are happening. And therefore, if somebody tells me, sorry, go ahead. Yeah, Shrija.
So I agree with you, and I think it's a very interesting point of view that perhaps the valuation playbook emerges from the manufacturing era, where the entire idea of super growth has changed. Those percentages of super growth has changed. But the question here is not necessarily about the fact that the quantum of growth. The question here, and what sort of Sanjay spoke about the fact that when you have to have larger outcomes, the capital burn has to be in that proportion. And you said that there are companies registering 10x growth, 3x growth, 5x growth, but also profitable growth. So the question here is about the profitable growth. So are we saying that where Zomato is justified in terms of, is that a perfect
I think that's very simple. Yeah, it's a very simple to understand. Again, I'm going to use an analogy. So startups, let's say seed stage startups, you got to compare them to the human life cycle. So these are like babies. Now, do you expect babies to deliver salary and earn money for you? Of course not, right? Which essentially implies that as the baby grows, like a Zomato, the name that you picked up, for example, or a Nykaa, for example, these are not old, traditional, mature companies. They are still growing rapidly, which essentially means if you were to analogize them to, let's say, human life, they are like teenagers. I think it'll take them another 5-10 years for them to really start showing profitability. Now, investors, there are all kinds of investors in listed markets as well as in private markets. Some of these investors really see that today, and they are betting on it, saying that this growth is going to turn profitable beyond a certain threshold. A majority of investors will not get it because we are all so seeped into the traditional way of valuing businesses, valuing companies, and say, "Arey, iska itna kaise ho jayega? How will it sustain?" There are all kinds of analysis out there. But the point is, if these guys are growing at a certain pace and they will burn money till a certain threshold, because adults, as on the human side, once you become an adult, once you finish your education, then you start earning money, is when the question of profitability comes in for a business, when you compare that same logic here. So there will be a time when your Zomatos and Nykas of the world will become profitable. Not yet.
Let me
I would
maybe
say,
come in with a slightly different
yeah, go
angle
ahead,
on
go ahead.
valuation, which is, see, ultimately, valuation is pricing, right? What else is it? It's about pricing, and pricing depends on supply and demand. It's a simple economic principle. I don't think there has ever been a year where we said valuations are perfect. They've either been too high or they've been too low. It's either a bull market or a bear market. There's no such thing as a perfect world with perfect valuation and perfect pricing. So again, I don't see this as a negative, right? This is the way the market matures. You go through peaks and troughs. You have capital that gets balanced out. So you see, higher pricing, you see lower pricing. I think we have to take this whole bubble conversation with a pinch of salt. I think there's money in different amounts of money in different stages, but ultimately pricing is a supply and demand phenomenon.
Okay, so
Tell
I
me,
think we
Srija,
have to put this. Yeah, I
all
think
these
we have to put
interviews,
this.
no, all these interviews, which VC has agreed कि ये bubble है?
Actually, as a matter of fact, there is one who has agreed. And he actually went on record to say that, and I must tell this to you, and I think it's a very, very candid revelation that said that if there is a startup which has actually been funded by SoftBank or a Tiger Global, we don't look at that space because the winner has already been chosen. And that is the reality of the VC market today. The VC model has been soft banked, no matter how much people deny it. Like the way in the retail market, you have Amazon, and the retailers used to say, "You shut shop, what happened?" "Oh, nothing happened, I got Amazoned." That really was the entire narrative. The same thing is happening in the VC market. If you have a similar looking company, exactly same technology, just few things are different. I mean, VCs are staying away, clear if it is SoftBank or Tiger Global funded. But that's, I think, a very separate conversation. We spoke about valuation, we spoke about the frenzy mania, we spoke about a selection of startups, is the deal making easy, and things seem to be pretty positive is what I gather at the seed fund, so at least from all three of you, and life seems to be happy as what I can see. Let's talk about the challenges here. And that was exactly what I was trying to get from all three of you. That what really are the challenges as you're building out your business in 2021, just given this entire liquidity, for the want of better word, say liquidity bubble only deepens, or liquidity scenario only gets better from here, or you are seeing or expecting a different scenario in 022. I'll begin with you, Esha. Get on to you, Rajesh, and then Sanjay.
I mean, at the risk of disappointing you, Shrija, it's hard for me to find a reason to say this. The excess liquidity is challenging, especially because for us that's the output end, and so the
Yes,
more
yes,
demand there
absolutely.
is for investors to look at our startups, the better it is, right? I think. If I had to really try and answer your question, I think one thing that is challenging is people have a lot of options. People who are thinking about entrepreneurship have a lot of exciting options, right? So a lot of this money means there's a lot more startups, lot faster growth, which means aspiring entrepreneurs are tempted to delay their decision to start up because there's so much, as I think we also spoke
That
about,
is
there's so
true.
much
Yeah.
search and excitement for talent. There's a talent crunch, right? And so the opportunities available today within startups are actually pretty high, pretty exciting. And so a lot of people who actually make great founders are delaying those decisions. So if I had to really nitpick, I would say that's something that I see as a challenge. But on the whole, good days. Can't complain.
Interesting viewpoint. So it's a deferred entrepreneurship as a trend, one can say. Just given the salary pool and the ESOP options, you would rather make that as a startup. So
Entrepreneurship is not a bad word anymore. Like 3, 4, not
yeah,
more than even 4 years
yeah,
ago, like
yeah.
youngsters, if they said that I'm leaving Accenture to join a startups, their parents would lock them up in the room, right? Like that's not the situation anymore. And I think that is how the ecosystem has really evolved very quickly.
Yeah. Rajesh, any last set of comments on this? I think we're getting
Yeah,
towards the end of this very
sure.
feisty and very interesting conversation, unraveled so many points. And this is the last round of the closing remarks on this. Yes.
If you take the last 10 years, and this is the 11th year running now, each year over the last 10 years, private markets in India have attracted more capital than public markets. Right? I mean, that's nobody realized that, but there's enough and more happening in India on the private side. And this is not just the frenzy that you're talking about in this year or last year because of pandemic. For the last 10 years, right? So there's enough and more happening. And why I'm still so positive about this, whole trend continuing for the next 5, 10 years is because now the biggest problem in the startup ecosystem is getting resolved, which has been exits. This year, just in this year, FY21, the calendar year 21, we are seeing exits in the listed markets or through strategic acquisitions of roughly about $50 billion. It's a big number. Now, exits in the startup ecosystem means who's getting this money? This money is going to either ESOPs, so employees are becoming rich, the employees belonging to this ecosystem, or it is the founders, or it is investors like us. What do we do when we get too much money? A large portion of that comes back into this ecosystem. So I will not be surprised if 22, the calendar year, the next calendar year, is actually better than what we are seeing now. Of course, there are challenges, but I think the biggest risk that everybody will be taking is by not participating here. That is the biggest risk. So please tell
Okay.
your viewers and everybody else to hop onto the bandwagon. Next 5 years, 10 years at least.
I am reminded of the fact that in public markets, there came a time where even panwalas used to talk about the fact, oh, Reliance IPO kharida hai. And that was a time when you knew that the bubble is gonna go where. And that was the pop that we needed and how the markets tanked after it. My only fear is that the kind of godlike structures that we have created and overawed figures that we have created with the recent successful listings, which everybody's overawed with it. And people are saying things like it's the best time to be an entrepreneur. I just hope that there's more reality to it than the fad, really.
It is real.
Sanjay,
I'm telling you, it's all very real.
okay, Sanjay, your last closing remarks, and then we wrap up this amazing conversation today. I really enjoyed it. Yes.
So, Srija, uh, you will be right at least once, in that sense. And
Oh, at least once.
I'm sure you will be
Oh
right.
my God.
But
At
but
least
but
once.
I wouldn't recommend. I would personally recommend you to join, as Rajesh said, not be on the sidelines, because you may be right once or twice, but rest of the time you are losing opportunity. And that's what I would say. There is, I mean, you mentioned about in 2022 and what we are preparing at 100x. We are looking at, how do we prepare high performance entrepreneur, right? Give them that winning edge kind of stuff. I mean, what we have figured out within the ecosystem is, small differences in ability of founders can lead to enormous differences in result. And in one of the anecdotal cases, I would like to, how do you help these founders win by a nose, right? Typically, if a horse runs a race and wins by a nose, it wins 10 times the prize money, right, than any other horse which participate in this race. So the question here for seed funds like us is, how do we nurture those kind of founders or help them scale? It's like we at 100x, we are working like a finishing school, like an Ivy school, where most talented entrepreneur want to apply and get their winning edge, in comparison to other startups in the same space.
Okay, thanks for that. And we should definitely do some quick rapid fire, given all of you are like such interesting people and felt really comfortable crossing each other. So, my first question, and I think it's open to all three of you, the most overhyped unicorn for 2021. And you have to give me a name.
Paytm.
Rajesh, Paytm. Wow. So there goes the name. Yes, Isha.
Oh no.
Now we know she's the politically correct one.
Okay, I will not say overhyped unicorn, but overhyped deal, Zepto.
Okay.
I agree with you
Sanjay?
110%.
Yes.
I
Sanjay.
can't agree on that. My brother is an investor, so
I
family
can agree because
purpose.
I've funded their competitor. So completely biased you.
So
Sorry.
Sanjay,
Srija, why don't
the
you answer
most
that question for us?
overhyped
What do you
unicorn.
think is the most hype?
Yeah.
Yeah.
What's your choice?
There's no choice. You have to give me the answer. There are no options.
Okay, for me, cred.
Okay. I think I would agree with all these three answers. And I think one piece of advice, which perhaps you got from an entrepreneur rather than you gave it to him, which has stayed with you for a lifetime, what would that really be? Yeah, Rajesh, you want to begin on that?
Yeah, of course. There's something it's just I remember this and I'll never forget it. Uh, we were discussing, and I think this is to Sanjay's point. He touched upon that briefly earlier. So we were discussing about whether we should take money from this guy or not, right? On a no-name basis. I had a different view than the founder, and I think what he said, resonated with me, and I'm like, okay, this is good advice. He said, when you want to build a large business, Rajesh, you have to deal with all kinds of people. So let's keep our views on the person aside and then see what is right for the business. And I think that's so true.
That is so true. Judgments don't really, I think people tend to
Very
be so
true.
judgmental at different points of life. It actually is detrimental for success. What about you, Isha?
So, very interesting one. We talk a lot about right to win to our founders. We talk to them about, what really is the reason why you can take advantage of this opportunity 10x better than anybody else trying to do it. And one of the founders spoke to me about want to win. I was talking to him that, you are perfect to do this business. You really know this industry in and out. You can move very fast. You have the network. He said, yeah, but I don't want to. He's like, short term, the right to win is great, but long term, I need to be passionate to get through the troughs and the peaks. And I think this 2x2 of the right to win and want to win is very interesting. And that stayed with me.
Interesting. Sanjay, what about you?
I think I'll just share a lesson, kind of what I learned from a founder. I had invested, and in demonetization because they were in real estate. The founder had to shut down the business. I continued to. The founder was great. I continued to back him for the next venture, and that went to become a unicorn. And the learning was ideas fail, founders don't fail. So that's what I would like to say. So ideas can fail. If founders are great, it's you should back those founders.
Okay, thanks for that amazing conversation and such interesting ideas came to the fore, which I'm sure will make for a very interesting watch for our viewers and very interesting audio cast for our listeners. Thanks for that, Esha, Rajesh, and Sanjay. Till the time I see you next, goodbye and good luck. Thank you.
Bye
Thank
bye.
you.